It seems like stablecoins are suddenly everywhere. Once considered a niche digital asset in the already niche field of cryptocurrencies, stablecoins are now being explored by major retailers, big banks, and even the US government. Stablecoin fever started to reach its peak in June, with reports that major companies like Walmart and Amazon are considering issuing stablecoins to help process transactions faster, cutting out middlemen like banks and card processors. Stablecoins have even attracted the attention of Capitol Hill. New legislation laying the framework for regulation of stablecoins pegged to the US dollar began making its way through Congress in June. But what is a stablecoin, and what makes it so attractive to businesses? Stablecoins are cryptocurrencies that are pegged to an existing fiat currency. This means that unlike cryptos like Bitcoin that are valued at whatever the market decides they're worth, stablecoins have values tied to already widely accepted money, like the US dollar. This relatively steady value protects stablecoins from the wild fluctuations seen in digital currencies like Ethereum and Bitcoin, making it easier to complete transactions. The trustless nature of crypto means transactions are secure and frauds and forgeries are nearly impossible. It sounds like a genius solution to many transaction problems, particularly those faced by companies that deal with a large volume of complex transactions, all happening at the same time across the world. Why bother with the entire complex network of brokers, credit card issuers, big banks, and clients? But these strengths can also be the source of their limitations. As it turns out, stablecoins issued by companies do have a widely used analog: the gift card, or even further back in history, company scrip. Stablecoins and gift cards share similar drawbacks. Despite being pegged to a widely accepted currency, stablecoins issued by a particular corporation are not universally honored and must be converted back into currency before the funds can be used elsewhere. And because the stablecoin is issued by a corporation, it may be difficult or impossible to convert the value back, even to the currency it's pegged to. While a third-party stablecoin like Circle's dollar-pegged USDC could solve a lot of these issues through widespread acceptance, it remains tempting for companies to create their own stablecoin. Like a gift card, a corporate stablecoin creates what's called a captive user, and that friction on behalf of the holder, not the issuer, makes it immensely profitable. The Genius Act hopes to address some of the shortcomings with stablecoins. It requires issuers to act more like banks, holding an equivalent amount in reserve and publishing audited financial statements if market capitalizations exceed a certain threshold. But critics of the bill say it does not go far enough and has loopholes that could create bank runs. Meanwhile, because stablecoins are themselves subject to trade, their valuation could fluctuate despite the peg, creating a potential for runs on the issuer. Circle's USDC coin, for instance, fell during the Silicon Valley Bank crisis in 2023. A push from corporations to create stablecoins could potentially cause confusion among customers, with individual companies only accepting their own stablecoins. Businesses are not standing still, with big banks reportedly in talks to create stablecoins to speed up transactions. In June, JP Morgan Chase Bank created a stablecoin-like token called JPMD. However, the token is only available to institutional clients and to simplify complex transactions like those crossing borders. It is not yet available to individuals. For Investors Business Daily, this is Mike Trong.